Rupee at 90 per dollar. Indian rupee fell below the crucial rupee 90 per dollar mark, unseating financial markets and raising broader macroeconomic concerns. The currency has now weakened over 5% this year. Analysts say that rupee's movement reflects both domestic and global pressures, including a strong US dollar and delays in the first tranche of the India-US trade agreement. Rupee breaches the 90 per dollar mark. The rupee slipped below the psychologically crucial 90 per dollar level, unsettling markets and intensifying concern over India's macroeconomic outlook. The rupee 90 mark is a critical psychological threshold for the rupee. Once breached, it can trigger buy stop orders and fuel sharper depreciation, pushing the currency toward rupee 90 or beyond. The currency has fallen over 5% this year, and the breach reflects a cumulative build-up of pressure, not a single shock. Strong domestic fundamentals have not stopped the slide. India's macro indicators appear supportive. Crude oil prices have eased, inflation has dropped below 1%, GDP growth hit 8.2% in Q2. Yet the rupee continues to face sustained downward pressure, revealing a disconnect between strong domestic fundamentals and the currency trend. Foreign outflows and trade deal uncertainty weigh on sentiment. Persistent foreign portfolio investor (FPI) outflows driven by profit booking and shift to other markets have drained liquidity and raised demand for the US dollar. Meanwhile, delays in concluding the India-US trade deal have heightened uncertainty about future trade flows, tariff competitiveness, and balance of payment outlook, dampening market confidence. Exports remain under pressure while a surge in gold imports during the festive season has amplified dollar demand. India's trade deficit shows signs of widening. India's external sector is under growing pressure as early indicators point to a widening trade deficit situation where imports exceed exports, increased demand for dollars and weakening the rupee. India's merchandise exports fell 11.8% year-on-year in October 2025, dropping to an 11-month low of $34.4 billion. The decline was driven by lower shipment to the US, a major export market, higher US tariffs, a high base from strong export growth in 2024. In contrast, imports surged 16.6% year-on-year to a record $76.1 billion in October 2025. While the trade gap is widening, the widening deficit is being saved by softening demand from major export markets, strong domestic demand for imported goods, unfavorable tariff conditions, especially with the US, weak export competitiveness across major sectors, gold's role in widening the trade deficit. The biggest contributor was gold imports, which tripled to $14.7 billion and amid festive season demand. Surging gold prices and massive import volumes have become a key force shaping India's trade dynamics. They have intensified pressure on the rupee, contributed to a widening trade deficit, and added stress to the overall balance of payments outlook. Implication for the rupee and economy. If these trends continue, India's trade deficit is likely to worsen, putting additional pressure on the rupee, widening the balance of payments gap and intensifying broader macroeconomic challenges. Uncertainty over India-US trade deal adds pressure on the rupee. Markets are increasingly worried as the long-awaited India-US trade agreement remains unresolved. Without a deal, analysts say the rupee may act as a pressure valve, gradually weakening for offset tariff disadvantages faced by Indian exporters. Until a clear announcement is made, markets are likely to price in the uncertainty, with the rupee reflecting it most visibly. Foreign investors continue to pull out of Indian markets. India's equity markets have underperformed for over a year, prompting foreign portfolio investors (FPIs) to steadily withdraw funds. Since January 2025, FPIs have pulled out Rs 1.48 lakh crore, exerting consistent downward pressure on the rupees. Why FPIs are selling despite strong macro indicators? Although India's macroeconomic backdrop appears stable, stock market performance tells a different story. Over the past year, India has been one of the weakest performers among major global markets. Despite occasional record highs, returns have significantly lagged those in faster growing international markets. As a result, investors have increasingly treated India as a liquidity source, redirecting capital to more profitable regions. RBI allowing the rupee to weaken. There is a growing debate over whether the RBI is intentionally letting the rupee depreciate. Many economists argue the central bank is not pushing the rupee down but simply responding to global shift and India's current macroeconomic dynamics. They note that RBI has been selling dollars only to curb volatility, not to target a specific exchange rate. Behavioral factors driving sentiment. According to experts, importers are buying dollars aggressively, exporters are holding back, waiting for better rates. The dollar index is below 100, which should normally support the rupee. They note that RBI's relative silence combined with IMF criticism of the rupee's movement is fueling negative sentiment. RBI soft touch strategy. RBI appears to be conserving firepower. Its forward book is already substantially drawn down, including in offshore and DF markets. It is using a measured approach, intervening only to prevent disorderly volatility, not to defend a specific level. This suggests a deliberate balancing act, allowing the rupee to find its market-determined level while remaining poised to step in if the slide becomes excessively disruptive.